If you put it that it was 999,000, you had a pretty good chance of getting a waiver. But if you put it that it was 1,001,000, you had zero chance because it was a hard stop at 1 million. Fannie and Freddie don't really want appraisers to be adding value. They want to suck all of that into their own mission, along with a whole bunch of other stuff.
Episode 19 of Market Moves with Mark and Jeff. Jeff, on the last episode, we discussed the FHFA announcement of the expansion of the appraisal waiver process. You and I spent a good hour kind of speaking off the cuff about this process. And as we were talking, and sort of in true Market Moves fashion, we started asking ourselves a lot of questions and realizing we don't have a lot of the answers. And so just a perfect opportunity to deep dive. Also, in Market Moves fashion, we continue to punch above our weight class in guests. I think that means that we are elite level grovelers, but I'm fine with that. So with us today is Senior Fellow and Co-Director of the American Enterprise Institute's Housing Center, Ed Pinto. Ed, very, very excited to have you here. Thank you for joining us, even on short notice, to maybe teach us and the viewers a little bit about this.
Pleasure. Happy to participate.
Yeah, well, I wanted to introduce you. If some of our viewers are not aware of the great work you've been doing for a long time and your prestigious resume, just wanted to introduce you for a few minutes here. So first, the American Enterprise Institute is a public policy think tank, in their words, dedicated to defending human dignity, expanding human potential, and building a freer and safer world. They have a housing center think tank, and Ed has been involved with that for quite some time. I have known of Ed for a long time. He was interacting with my father a long time back. Ed, I imagine you don't remember, and that's perfectly fine. Way back when, but I knew of you from those times then. In the 80s, you were executive vice president, chief credit officer at Fannie Mae. Frequently interviewed, even recently, radio, television, writing's been published. Boy, goodness, I've got American Banker, The Hill, Real Clear Politics, Wall Street Journal. You've been everywhere. So quite the resume, and we feel very fortunate to have you here. I was looking that the focus of the work that you in the Housing Center have been doing continues to be the role of federal housing policy in the 2008 mortgage and financial crisis. And I highlighted this and how federal housing policy continues to create unwelcome distortions in the housing market. And I thought that was, at least for me, was a tie-in to what we're going to be talking today, which is appraisal waivers and how this may or may not be creating distortions in the marketplace, at least from my perspective. So maybe kick off there. Is that an accurate reading?
Absolutely. And I've been studying this, as you say, for many years. It goes back to the role that the predecessor agency to the Federal Housing Finance Agency, known as the Office of Federal Finance Oversight, Enterprise Oversight, OFEO, which was established in 1992. And that was, I left Fannie Mae in 1989, and so that was a few years later. And that's really where things started running off the tracks, because Congress passed a law known as the Federal Enterprise Safety and Soundness Act of 1992. And not too different than today, whenever Congress passes a law that says safety and soundness, you have to hold onto your wallet. Bill Clinton, the law was signed by George Herbert Walker Bush in 1992, but Bill Clinton in 1995 came out with the National Home Ownership Strategy, and he famously said at a National Association of Realtors convention, this affordable housing approach or mission here, which had been imposed on Fannie and Freddie in the 92 Act, will never cost the taxpayers one red cent. Of course, he couldn't have been more wrong. You fast forward through the 90s, tremendous loosening of underwriting requirements, which took place through the aught years up to 2006, 2007, of which Fannie and Freddie were front and center in that. FHA was somewhat involved. HUD was very much involved because they were actually responsible for the affordable housing goals imposed on Fannie and Freddie. And Fannie and Freddie went into conservatorship in 2008 because they were basically bankrupt, and they had to be rescued by the federal government and Treasury Department, and they're still in conservatorship. But now they have a different regulator. That regulator is the Federal Housing Finance Agency, which is both their mission regulator and their risk regulator, and their safety and soundness regulator. And that's important because when we look at things like these appraisal waivers, the purpose of them are to advance the affordable housing mission. Oh, this is going to make things less expensive for the home buyer, and therefore that's why we're doing it. And we'll come back to it, I'm sure, but that's why they've extended this waiver process very much into much higher loan to values for purchase loans. In the past, it was not very prevalently used on purchase loans because the loan to values were low enough that there just wasn't a lot of demand there. But this is all very important because we've seen this movie before. And back in the 90s, the late 90s, Fannie and Freddie both developed their automated underwriting systems. Fannie Mae's was called Desktop Underwriter. Freddie Mac's was called Loan Prospector, LP. And they basically, and of course, they were competing with each other, particularly competing for these affordable housing loans that they were subject to by HUD in terms of their goals. But they were basically two combatants chained together, the two legs chained together, and they were beating each other over the heads and shoulders to get the same group of affordable housing loans. And the question was, who could race to the bottom the fastest, because they were going after the same loans. And on the side, they were competing with FHA up until about 2001, 2002. And then they were competing with subprime, private subprime after that. So it was a crazy situation. So Fannie and Freddie come out with this automated underwriting, and they actually, over time, tie it to their affordable housing goals. So Fannie comes up with something called expanded approval. Well, what's expanded approval? Oh, we find out that a loan is actually going to qualify for affordable housing credit. So maybe we should expand the credit box to make sure it gets approved. It's literally called expanded approval. And well, how do we do that? Well, one way to do it is, as the loan is being put in by the broker or the lender, we on the fly will expand that credit box. But at the same time, we gave the lender and the broker many bites at the apple to put the loan in and change the parameters or the facts around the loan. So this particularly relates to income and the qualification under a debt to income ratio. And so, you put in the loan at, and I'm going to make up some numbers. I don't know what the numbers would have been back 25 years ago, 20 years ago. But you put in that the person had $35,000 of income. It comes back full documentation, fully documented income. Oh, well, what if I put in 45,000, full documentation? Well, what if I put in 55,000? Oh, no doc. Oh, great, I don't have to document it. Well, of course, you couldn't document it because you just made those numbers up. But Fannie didn't know that, and ultimately Freddie didn't know that. And so now you had an approval without any documentation. You're off to the races. Now, if that sounds somewhat similar to what we'll be talking about here in terms of appraisal waivers, there is a great similarity between the two. And again, what Fannie and Freddie did was they allowed a number of bites at the apple. Of course, if you didn't get the answer you wanted from Fannie, you could always go to the junior partner across the river, Freddie Mac, and see if you get them to approve it. And so this was so bad that I actually, after they went into receivership, I went to the Security Exchange Commission to tell them about a lot of things that Fannie and Freddie were doing. And they launched an investigation. And one of the things that they found was that Fannie, in its disclosures, its SEC required disclosures, was saying one thing, but was actually happening was something else. And the something else that was happening was, well, Fannie said, oh, we're not going to list that loan that we said could be done without documentation as a no-doc loan because the lender didn't request it. We offered it along the way, and therefore it wasn't actually a low-doc loan. And the SEC said, no. That's a violation of SEC disclosure requirements. And Fannie Mae was actually found guilty of that. Of course, since they were in conservatorship, they got a slap on the wrist. They also found Freddie Mac had violated all kinds of things also. But those are the kind of things that happen when you have the pressure coming from your erstwhile regulator. In that case, it was HUD. But now we have the pressure coming from FHFA.
Wow. Boy, yeah, that's such a great historical perspective and kind of lead up, I think, Ed, to where we find ourselves today. And I think, as you alluded to, very much, these, how can we expand the credit, that leads to, not the only factor, but leads to the downside, the conservatorship. And I think by the end of this conversation, we'll circle back a little bit and maybe discuss what some of the impacts of the conservatorship incentives in risk analysis, might be from Fannie and Freddie's perspective. But Mark's pulled together a couple of slides that you guys have put together, Ed, and I think we'd like to talk through or maybe just analyze these a little bit. This first one that Mark's pulling up here is just documenting or highlighting the prevalence or the utilization of the appraisal waivers in the process. It looks like starting in maybe 2016, 17, 18, it starts to get off the ground just a little bit, but then we see a real ramp up leading into and kind of in the height of the COVID environment that we were dealing with. What's your overall observation as far as the ratchet up of these appraisal waivers as they first got kicked off?
So I would make two observations. First, the waivers were being used before the pandemic, and that's what shows up here. Not obviously as much as they became to be used, but basically the pandemic provided an opportunity because of the desire not to have appraisers enter people's homes and the borrowers not to have people enter their homes. They basically used the waiver as a way to meet that concern. And so we see this hockey stick, as we called it, in the explosion of the waiver usage. Then it stayed relatively high. As I think you have another slide that shows it's now come back down. That's coming back down for two reasons. One is that refis are, and this is percentage of refis, but the prevalence of refis have come down tremendously because interest rates have gone up substantially from where they were in 2020 through 2020, end of 2021, early 22. And so I think you see here, it's gotten back to a lower level, but still quite a bit above where it was back in pre-COVID days.
So you guys did your first report in 2022, or released it at least in 2022, correct?
Yeah, we were tracking it before that, but our report where we wanted to get into the opportunity for gaming, that really was in 22. That was our first foray into that.
Wonderful. Okay, so not gaming isn't wonderful, but good to have that.
Now, I was attuned to gaming for the reason that example I just gave. And again, I'm always wear my chief credit officer hat, and I also, before I was chief credit officer, I was head of marketing and product management, the senior vice president at Fannie Mae. So I've been on both sides, the marketing side and the credit side. And so I'm very much aware how underwriting provisions and the automated underwriting that Fannie and Freddie adopted can lead to opportunities for gaming, which the mortgage industry broadly defined. Here we're talking about appraisers to some extent, who are basically out of the process. So it's what Fannie and Freddie are doing, but it's really the people who are going to be putting in that estimate of value. And as we'll see, that's where the gaming opportunities abound. And we predicted that there were gaming opportunities. We said we don't know of any, but we see some telltale signs of that in terms of anchoring. But we actually, I think within a year after we came out with this report, I believe it was Wells Fargo, don't hold me to that, but I think that various loan officers were actually had found a gaming opportunity at the high end of the waiver limit. The waiver was limited to values of $1 million or less, or under $1 million, whatever. And therefore, if you wanted to get a waiver, you better not put that the value was $1,001,000. If you put it that it was 999,000, you had a pretty good chance of getting a waiver. But if you put it that it was 1,001,000, you had zero chance, because there was a hard stop at $1 million. And people figured that out. And that's, again, how people game the system. They eventually start seeing inside the black box based on what's coming out of the black box. They don't know what these rules are necessarily, but they start seeing output from the black box. And they start putting two to two together and say, oh, I'm a fool to put in $1,001,000. I might as well lowball it by a few $1,000s. Now, what's the risk of doing that? Well, maybe it's very little, but it again tells you how you can game the system and get the feedback you need to create that gaming.
Boy, it sure resonates with me. And appraisers often, it not having anything to do with valuation, but how we get orders. We have to figure out how systems work, and you don't know the rules, but you'll learn over time, and you figure out what's working and what's not. So I think you've said this twice, and so hopefully I'm not misunderstanding, but I just want to emphasize it if it's true, that you started this waiver analysis because you thought there was potential for gaming. So it wasn't simply tracking, hey, we just want to know how much waivers are being used.
Well, no, we started with, we wanted to track the waivers, but then when we found out how prevalent they were, we eventually said, okay, what's the gaming opportunity? And it was actually in that first report in 2022, we said, well, how are the results of the waivers comparing to the results of human appraisers? And what we found was that, and I don't know if you have a slide on that, but that the in general, the waivers came in a bit below the human values at the same LTV points, except for these particular spots where you had anchoring. And what's anchoring? Anchoring is there are certain points that the loan to value, for example, is important. 75%, maybe some underwriting rule changes at 75. There's a lot of things that change at 80. You go above 80, you have to have mortgage insurance. At 80, you don't. It's very important on a refi. If you have an FHA loan today and it was originally 97% and you had some home price appreciation, you probably don't want to refi at a 90 LTV because you're still going to have to pay mortgage insurance. Boy, if you can get that down to 80 or below, all of a sudden the mortgage insurance drops off and you get a lower interest rate. And so that's where the MAI designation, which is jokingly referred to, made as instructed, came from, because you'd walk in and the appraiser would walk in and say, what do you need? Again, on a refi, because the appraiser, if the appraiser came in $500 above the point that would kick it right above an 80 LTV, that was going to be very expensive for that borrower, because they were going to have to keep the mortgage insurance. So those are the kinds of things that intrude on coming up with an answer that's completely objective and isn't affected by various anchoring. The other anchoring that, of course, takes place on purchase transactions with an appraiser is they know the sales price. And again, if an appraiser, if a house is selling for $200,000, is an appraiser really going to come in and say it's worth $199? I don't think so. He's going to say, actually, I'm going to say it's 200 because what's the difference? There's not really in the scheme of things and the accuracy of what I'm doing, I really can't tell the difference between 199 and 200. The problem, of course, is that that range could get larger. Oh, what if you were coming in at 190? Well, now you might stretch it to 200. Well, that we'll come back to this as we talk about the appraisal waivers. That's where the appraisal waiver anchoring can come in on purchase transactions. It's not a human that's going to be anchoring to the answer. It's going to be the waiver process that's going to anchor to an answer.
Yeah, that's interesting, Ed. And so maybe as we are diving in here, what's your understanding of how this waiver process works? You're talking about who's like where that value's coming from in the first place when there's not the appraisal being generated, and then the potential for that that anchoring. How is the value derived then if there's an appraisal waiver on a loan?
Well, first of all, let's talk about a little bit about how the appraisal process, waiver process works. So Fannie Mae and Freddie Mac have massive amounts of data, and this is something we've commented on and complained about. They're getting this data as basic government agencies, and who are they getting it from? They're getting it from lenders, and who are the lenders getting it from? They're getting it from appraisers. And yet Fannie Mae and Freddie Mac are sucking in all this data, and they're loath to put it back out. And that data, is tens of millions of appraisals that they've, accumulated. This is their appraisal data set. They've started releasing some information, but it's still nowhere near, granular enough to actually do the kind of research that needs to be done. They're inching their way, but they're sucking it all in like a vacuum cleaner, and then they're using it to create information about areas, the condition of homes, in an area, and then they basically put together their automated valuation process. But it's more than just an automated valuation process in a traditional sense, an AVM. They also have all of this condition information that they're getting. They also have their own quality control that they're doing. They have all this information that they're sucking in. They have borrower information. And so when they actually have inside this black box, are we going to approve a waiver on this loan? They have some hard stops for loan to value and combined loan to value, but they also have some other things that seem to impact some borrower characteristics. Again, it's hard to fathom what those are because they're inside their black box underwriting process. But we can get some glimpses of them. And so it's not just an AVM. They have some other factors that they look at. Where this becomes, again, important is they're shifting from the use on refinances. If you can bring that more recent refinance chart back up, the prevalence by purpose, so you can see that purchase is the blue line, and it's down at these new programs, which they have an alphabet soup of new programs where you can get a transaction without without an appraisal or inspection, or you can get it with the waiver, but you have to have a human go in and do the interior inspection. You can see that the percentages are very low, and even the percentages for the refinances have been relatively low, except where you do the inside inspection. But what's happening is they're expanding the loan to values for using purchase, and this comes back to the affordable housing requirements. So the Fannie and Freddie are expanding the eligibility for appraisal waivers for purchase loans at the behest of their safety and soundness slash affordable housing mission regulator, who now is wearing two hats, serving two masters, a safety and soundness master and a mission, affordable housing mission master. And the FHFA explicitly said they're doing this waiver process and expanding it to 90% loan to value, or probably combined loan to value for purchase loans, without any interior inspection, and up to 97%, I believe, where there is an interior inspection. That's a big expansion from 80%, because that pulls in a lot of additional borrowers, a huge swath of additional applicants, but it also pulls in, by definition, the people that are in the affordable housing program, because those are the people that have the higher loan to values by and large. And so I always am concerned when the reason given for a policy change, a underwriting risk policy change, is affordable housing, because they shouldn't be making this, again, putting on my former chief credit officer hat, they shouldn't be making changes based on the affordable housing mission. They should only be looking at them from a safety and soundness perspective.
Boy, Ed, you are hitting on something. I've done two podcasts, one our own and one on Brian Reynolds' podcast, where I was quoting the FHFA announcement of the expansion of these waivers, and I quoted the reason provided, which was the mission-driven reason that you're talking about, of saving a few $100s for low-income borrowers on a $200,000 loan or whatever it is, and not at all providing reasoning that these are not upping the risk of bad loans or something along those lines. Like it seems to me that the reason to do this and should be provided, that hey, we're not making bad loans as a result of this, if that's the story, right? And it's just not mentioned anywhere.
Well, and again, we've seen this movie before. We know how it potentially ends. They all through the 90s and the aught years, they said, not to worry, we know exactly what we're doing. And so one of the problems, again, with having Fannie and Freddie competing with each other, is that, and this went back, Fannie and Freddie, through their automated underwriting, basically said, oh, we have a secret sauce. Fannie had its secret sauce called Desktop Underwriter. Freddie Mac had its secret sauce called Loan Prospector. And that secret sauce is going to do a better job of figuring out who a borrower is and how they're going to perform than not having the secret sauce. Well, wait a minute. Are you trying to tell me that Fannie's system is going to be so much better than Freddie's, but Freddie's saying theirs is so much better? Who's right? Well, it turned out they were both wrong. And that sort of has to be the answer. Because what happens is, if Fannie approves a loan with their secret sauce, but turns down a loan using their secret sauce, the lender broker is going to submit it to Freddie, and Freddie's secret sauce may approve it. Well, wait a minute, what did that just do? You just expanded the credit box. You both say you have a secret sauce. How can that be? And that's one of the reasons why we ended up with the mess we ended up with. Secondly, when FHFA announced this, they actually said sort of gratuitously, oh, and this doesn't present any risk problems. They had a sentence or something where they said gratuitously something along those lines, as I recall. But Mark, to your point, and again, we've seen this movie, we know how it ends. Back in the 90s, Fannie and Freddie, particularly Fannie, were on a mission, no pun intended, to reduce some of the closing costs. There wasn't appraisals at that point, although they did a little bit with some drive-by appraisals on refis and things like that, starting in 98, 99. But it was other things where they thought they could reduce some of the costs. One of them was, famously, they originally, back in the 80s, if you had a loan above 80%, it required mortgage insurance, and the mortgage insurance had to be down to, I think, 75%. So you just couldn't insure down to 80, actually had to insure down to 75. Eventually, for affordable housing reasons, I have the analysis in my files. Fannie figures out, no, we don't actually need to require that it go down to 75. The charter only requires it go down to 80. And so they introduced what was called charter coverage, where you only go down to 80. And they said, look, our cost of capital is lower than the cost of capital of a private mortgage insurer. We will then only go down to 80. They don't need as much capital. We will then take on that capital risk, which of course they didn't end up having enough capital, which is why they went into conservatorship and still are. But that had completely unintended consequences. Yes, it reduced the cost to the consumer, and I'll come back to that in a moment. But they really put the mortgage insurers in a really bad position. Why? Well, the mortgage insurers still had all the fixed costs of underwriting a loan. Underwriting a loan costs X, whether you're down to 20%, if you're providing down to 80% or providing down to 75, it costs the same amount. And when you have a loss, the difference between paying a claim down to 80 and claiming down to 75 doesn't make all that much difference. So the mortgage insurers were left really holding the bag more than they would have if Fannie and then Freddie hadn't made that change. But there's another issue that is pertinent to what we're talking about here, and that is dollars are fungible. And so if you save $300, and I don't remember what the mortgage insurance savings, but Fannie trumpeted it. Oh, we just saved X dollars, whatever it was. Well, dollars are fungible. If all of a sudden, and you have a tight housing market in terms of supply, and a borrower that has X dollars saved up, and they don't need to spend $300 in appraisal, whatever it is, those dollars are there. But if the market is tight, what are they going to use those dollars for? They're going to use them to bid up the price of the house. Supply and demand economics 101 tells us that has to be the case. Yeah. And we've been in a seller's market since January 2012. So we're 23, 22, 23, 24. We're now in our 13th, finishing up our 13th year of a seller's market. And as appraisers, you know what it means to be in a seller's market. That means the seller has pricing advantage to the detriment of the buyer. And that means that if you provide a little more jingle in the pocket of the buyer, the seller sniffs that out like a cat with catnip, as does the real estate agent.
Boy, yeah, exactly right. I love the analogy and kind of the summary there, Ed. So really appreciate it. As Mark's pulling up this next slide here, there are a couple of things I think that pertain to the appraisal waivers that are worth just making sure that we have clarity around. One of these things that I thought was interesting along those lines is we've got pulled up here is, so we've got this human appraiser, this graph showing human appraiser values compared to the appraisal waiver values, and I'm seeing a spread there. Now, just because the inquiring minds want to know, I'm kind of curious, Ed, if you have any perspective on what's used in this analysis that you've done as kind of the source of truth. We're seeing an overvaluation or an undervaluation. Do you have a sense of how, like, we've got the appraisal waivers providing value on the one hand, we've got the human appraisal on the other. Do you recall, or do you have a sense of kind of what the source of truth of the true value of the properties are in measuring the variances here?
It's been a while. I don't.
No worries. I'd like to say just
I'm sure in the document there's a methodology section and it explains that.
Very good. More homework to do on my part, so no problem there. It was interesting to see, however, the spread here between the appraisal waiver value and the human appraisal value. What's your perspective on what accounts for that, and why is the spread what it is, do you think?
So this goes back to how the agencies use the waiver process. So they've got all of this, magic stuff that they do in this black box. And so now you have a loan application that comes into Desktop Underwriter or Loan Prospector, And in that loan application, be it a purchase or a refi, but let's now switch to purchase, you have an estimated value of that property. You haven't done an appraisal yet. This is before that. The property is estimated to be worth $300,000. How did we get that? Well, that's the purchase price, is $300,000. So Fannie and Freddie take that, put it in through all of their algorithms and stuff, and say, given the LTV, given the other factors, yes, this loan is eligible for a waiver, but now are we going to give it a waiver? And so it's in at 300,000. The chance of Fannie Mae's estimate or Freddie Mac's estimate coming in exactly at 300,000 on an automated, whatever they call it, they don't call it an AVM, but whatever they call what they are doing, they have a name for it. At 300,000 is slim and none. So they actually come up, I think, with a band that we think the value is somewhere in this band, which could be 200, and I'm going to make up numbers, 290 to 310,000. I don't know what their band is, and that band could vary based on these other factors. And so it could be a moving target. And so now they say, oh, 300,000. Yes, we can conclude that 300,000 is an acceptable purchase price. Therefore, and it's 90 LTV or below, and it meets our other requirements. So appraisal waiver, no interior inspection. Now, you can see where let's take a newly built subdivision where the houses are pretty much priced the same, let's say for given model, 300,000, and all of a sudden you see, boy, 300,000 got approved. I wonder if I had a price of 305, would that get approved? Oh, wow, that got approved. Well, what about 310? Well, yeah, but 311 doesn't. And I'm just, again, coming up with a stylized example. I'm not sure exactly how you're going to get this feedback, but you can see where this goes because they figured it out on the income side. They'll figure out a way here. And as we also see, if you can bring up the anchoring slide. So this is just looking at month by month, and it shows that the appraisals come in, generally below or always below the human one. But when you look at it, you have the new anchoring one, the one I just sent. So rather than looking at month by month, we're now going to aggregate the volume over a time period, and we're going to look at it in the x-axis by loan to value or combined loan to value. And you see some distinct spikes, the orange spikes, but you don't see those spikes generally. Oh, there's one around 80% on the human appraiser, but you don't see those on, but you do see them on the waiver. And they occur, as you've highlighted here, at 60 LTV, 70 LTV. There's a small one at 65, but at 70 LTV, 75 LTV, and a big one at 80 LTV. That big one at 80 is for the reason that I kind of mentioned. You no longer need mortgage insurance. And that's on a no cash out refi, which goes up to, as you can see, 90% LTV. So, well, how is that happening? So whatever is happening, there is an opportunity for a potential opportunity for gaming because we can see that there's anchoring going on. Now, how that anchoring is exactly happening, we don't know. We're seeing the manifestation of it. And that's what gives us pause. When you shift over to the cash out, you see at a 60 LTV, there's some anchoring there. There's some anchoring a little bit at 65, and then at 70, and of course, 70 was the limit on cash out refi, and therefore you don't have the opportunity after that. But there is some anchoring that happens with the human appraisers, something above 80 for whatever reason. So again, these are just telltale signs. Yes, the waivers seem to be coming in lower, but there is an opportunity for this anchoring, which then leads to the opportunity for gaming. And that's where I'm concerned about the purchase transactions, because we're talking about somebody really paying overpaying potentially for a home. And of course, FHFA says we're trying to help these low-income buyers get into their home, but if the house goes up in value because of it, I'm not saying that's happening or will happen, but we've identified, again, these telltale signs that would lead one to be concerned about this, and we will, of course, be tracking this to the best we can. We have looked at purchase transactions so far, but again, they're at relatively low loan to values, maximum of 80, and we haven't found any anchoring showing up yet. But this change doesn't take place till next year.
Boy, the picture or the puzzle really gets pulled together by you here in the reporting and then your explanations of it. Really, really fascinating to see this, and just makes logical sense how these things could happen on a whole number of fronts. And like it feels like the appraiser. I think that these firewalls that have been created for the appraiser helped eliminate some of this. And purchase prices are still there, and our requirements to review pending purchase contracts in each appraisal create this. But boy, I remember the comp check days of the early 2000s and late 90s where, hey, let me know what you think the value is before I get you the order. That was when I was cutting my teeth in the space. And so you could see how this anchoring and the gaming was, I was an appraiser, was a pawn in the gaming that was taking place back then.
But let me just add one thing, because I hold no brief for appraisers or the appraisal industry. As I mentioned, I started in 1992. I came up with my own AVM. And we started talking about automated valuations at Fannie Mae back in 1985. I remember the day we were chatting about it. And that's how I got interested in it. And I eventually, when I left Fannie Mae in 1989, I started doing some work in that area. And as I said, eventually created my own AVM in 1992, 93. The issue I have is if this were done by truly private companies with truly private capital without a government guarantee, and there were multiple companies doing it, that's one thing. The problem is when it's done by Fannie and Freddie, who again are tethered together at the ankles to meet affordable housing goals. And their regulator is explicitly saying, we are giving you or ordering you to do this flexibility in order to help meet the goals. That's when I get really nervous, because again, I've seen this movie before.
I'm extrapolating here, and I'm sure you'll correct me if I'm wrong, but us appraisers are always grasping at acceptance from stakeholders, like knowledgeable stakeholders, one way or another. And Jeff and I, early on in our podcast had the former Appraisal Institute CEO Cindy Chance on, who gained a lot of popularity, deservedly, for defending appraisers but not being an appraiser. And I think that feels good to all of us, because it feels like stakeholders out there are rooting on the elimination of appraisers, which is ultimately sort of devaluing our value in a healthy mortgage market. And if I were to, I want to ask next, Ed, because I'm craving your approval or acceptance of what we do here. But what is the if there is potential gaming here, what should be the valuation process instead?
So, as I said, first of all, I do not favor Fannie and Freddie doing this. Okay. I would much rather private entities doing it that are privately capitalized and don't have some of the misguided reasons, which again, as I said, they're regulators wearing two hats. They're wearing a safety and soundness hat, and they're wearing a mission hat. And they've let the mission hat, in this case, overcome the safety and soundness. And they explicitly said from the mission person who put this out, oh, there isn't an issue. So that's number one. Number two, the issue here on purchase appraisals, and it was compounded under Dodd-Frank, where the requirement became a requirement that the appraiser be given the purchase contract. Ideally, if you were doing, you'd want it to be blind. I'm familiar with, there's only two circumstances where you have a blind situation. Circumstance number one is relocation appraisals, relocation appraisals occur before the sale of the property because the employer is going to buy out the employee before the property sells, and therefore they have to come up with a value, and that value has to A, be accurate, but B, they can't anchor it to the sales price because there isn't one.
Mhm.
And I'm familiar not with recent research, but research from years ago that showed that relocation appraisals were very accurate. Secondly, you can do a post-mortem on the refinance appraisals, and I actually did one back in the 90s when I was doing a rate and term refinance program for a bank, and we ended up with something like 3,000 refinances in Montgomery County, Maryland. And we went back and we looked at instances where the property had sold within 12 months. You know, it obviously hadn't sold before the refinance was done, but it had sold for whatever reason within 12 months after the refinance. And we looked at the appraised value versus the sales price. We adjusted, for any time differential. We had a method for doing that. And what we found was an extraordinarily normally shaped bell curve that was very tight. I don't remember the exact numbers, but my recollection is 70% of the results, or even 80%, were within plus or minus 5%. Now, I had personally been involved in selecting the appraisers for this program, appraisal companies, and I explicitly said, if anybody with the bank says, here's what I need, quit. Stop doing the appraisals. I do not want that. And so that was a way to test that. It's hard to do because you actually have to go back. We have a plan to try to do that backwards look, but we just haven't gotten to it. So what does that mean? Where you don't know the answer is the best protection from anchoring, number one. And in a purchase transaction, that means you would have to come up with a range and a confidence factor. So as appraisers, you could see that this is a cookie cutter house. There's 20 others in the neighborhood. We've got 3 comps or 4 comps or 5 comps, and they're all almost identical, whatever, their recent sales. I'm going to come up with a range of, $297,000 to $305,000. The sales price is $300,000. I'm going to call it that. And my confidence is, pick a number, 90%, whatever, that it's within that range. Now, appraisers are going to have to learn to do things a little bit differently. They're going to have to learn some techniques and some statistics, but you could come up with that. On the other hand, you have a home that's in a more rural area. The comps are further away. It's a wider range of comps. They're not as similar. And the appraiser may say, okay, my range on this is from 280 to 315, and the sales price is 305, but I've got an 80% confidence factor in that. That would give the ultimate risk taker, the lender. Now, in this case, again, Fannie and Freddie are taking all this risk by and large, but in a real world, you'd want the ultimate lender making a decision. Okay, am I okay with that risk level on that particular transaction? Because I know that, and I actually said, and the property was going to sell for $300,000. You'd want to do it without the appraiser knowing what the property is selling for. So you wouldn't want the appraiser seeing the sales contract. So he would come up with this range, and then it would be the lender's job to say, oh, the sales price is $300,000 or $305,000. Okay, I'm okay there, and I'm okay with the accuracy level the appraiser gave me. I'm okay with his range, and therefore I'm going to make this loan. That's the only alternative I see. We are a very long way away from that, and I don't see Fannie and Freddie going there.
I would love it if they did. And I've thought for a long time, appraisers, we deal in ranges or bands, like you've referenced before. We'll look at comparable sales, we'll adjust them out. Inevitably, we have a range, and exactly as you've just illustrated, in a pretty homogeneous market, we'll have a pretty tight range of adjusted pricing and a pretty high confidence that the value should fall within that range. In a more rural area where I've got much more variability in pricing and much more limited data set, that range is wider. My confidence is not as good. I just had a friend reach out to me within the last week. Hey, I found a home that I want to buy. We're going to make an offer on, but they want us to have our home on the market before they're going to accept our offer to buy this new home. I need you to give me an appraisal and tell me what this thing's worth, but we're trying to sell fairly quickly. So I kind of talked through exactly what this discussion's been. Look, I can give you an appraisal. There's going to be a range. If you're motivated to get it sold in a pretty short time frame, you might want to be on the lower end of that range. So I provided the appraisal. I put the value kind of in the middle of that range. And so he looked at it with that advice and said, well, we're going to list it a little bit below the appraised value. And lo and behold, within 2 days, they have a full price offer at their listing price that was slightly below the appraised value. But, just an anecdote, I think, that illustrates very well what you're talking about. If we're really providing in a mortgage space a tool to assist in risk analysis, a range of value could be equally useful in that determination to a point value that the appraisal's providing, and may, with confidence scores, even better help identify what their risk in the value of the collateral is. I love your perspective. I've seen it that way for a while, and even in practice, with this story that just came to mind, that's exactly how it played out, and everybody walked away happy.
Well, and this is the point. It plays to the expertise of the appraiser. Right now, I think the agencies, Fannie and Freddie, view the appraisers not having any expertise, not contributing anything. And so I think the challenge for the appraisal industry is, what are you going to contribute when you grow up here? Because the world's changing. If you don't figure out what you're going to contribute, you're going to be left with smaller and smaller pieces of the pie, and find where you can add value. But let's be clear, Fannie and Freddie don't really want appraisers to be adding value. They want to suck all of that into their own mission, along with a whole bunch of other stuff. That's been there. I have a graphic that I've used many times called the Blob, from the movie The Blob. We actually use the Blob from the movie, and it shows how Fannie and Freddie take over everything in the mortgage insurance industry. They were trying to do it with title insurance. They just want to take over everything. If they could take over credit scores, they would try that. They're just always looking to expand and enrich themselves in the process, but they do it in the name of, oh, we're doing this for affordable housing. We're doing this for first-time buyers. Well, we've been there, done that. They didn't do so much for first-time buyers back in the 90s and the aught years.
Okay, last question, and this is a red meat question, I think, Ed. We were talking a little bit about this before the show started, getting prepped here. But we just had an election this week as we're recording this, so this won't be released.
Oh, who won?
As close as they were projecting.
Yeah. So conservatorship. So we had an episode a few weeks back dealing with the different housing policies of a Trump presidency and a Harris presidency. And one of those key differences, it seems, would be their views on conservatorship. Maybe the Harris presidency would see it as a real benefit to affordable home ownership and that sort of thing, a tool. Trump, I think, was doing some work in his first term to move towards privatization. Do you think privatization is coming now that we know that we have a Trump presidency coming? And what are the challenges, if so?
Well, I think the spirit is willing, but it's going to be a difficult path to execute. I think they're going to take a look at it. They may start proceeding down the path, but that path has many, many steps to it. And it's going to take a number of years. It's not something to be done overnight. They really need a lot more capital, and how much capital they need is a big question. It's going to depend on what the rating agencies say. It's also going to depend on what backstop they have. And it's also going to depend on the taxpayers are owed a lot of money here. The taxpayers own, through the Treasury Department as their agent, 79.99% of all of the common, they own warrants to purchase 79.99% of all the common stock. And you, Mark or Jeff, you probably have enough money to exercise those warrants. they're at fractions of a fraction of a fraction of a penny. Doesn't add up to a lot of money. Number one. Number two, the Treasury has, I forget how much, hundreds of billions or 150, $200 billion of special preferred stock that they're owed. I mean, this is a lot of money here, and that's owed the taxpayer. And of course, the government mortgage complex, as I call it, is going to say, oh, they've already paid for that. And my perspective is to take an expression from MasterCard, what's this experience worth? It's priceless. Well, how much do you think Fannie and Freddie would have to pay in 2008 going forward to 2024 and continuing to have the backstop from a AA plus entity that has in perpetuity and on any mortgage-backed security they issue for the next 30 years of each of those mortgage-backed securities as they're issued? And what is that worth to them? It's priceless. What have they paid for it? Zero, nada, nothing. So again, that's why they got the warrants. That's why they got the special preferred stock. But the reason they got the warrants for 79.9% of the common stock was because that's what they're given. But that agreement that put them in a conservatorship also provided for a fee to be paid for that backstop. In addition to everything else, how much of that fee have they paid? Zero, nada, nothing. So again, they've gotten something priceless. How many mortgage-backed securities, what volume of mortgage-backed securities could Fannie and Freddie have sold if they didn't have that backstop? The answer is zero.
Wow.
None, nothing, none. So again, it was priceless.
Well,
we'll see what
I think
happens.
that makes sense. And you started out that answer by saying, the spirit might be willing, but there are practical realities that will make it difficult to do. And I think you've very clearly identified some of those, potential hurdles or maybe even disincentives to come away from that, that blanket or that backstop. And I think we wanted to, kind of wrap on that question, because a lot of that priceless experience that you've just illustrated, I think, informs the decisions that are being made from a risk credit management perspective. If there is a backstop beyond just them, as opposed to if they were, fully autonomous and accountable to themselves and only their shareholders for going out of business or something, if they make poor credit risk decisions, that calculation of how many loans should we guarantee or backstop changes a lot, with or without that conservatorship status and the backstop of the federal taxpayers. So.
Well, let me add one more thing, which is that you want predictions. I would predict that when the Trump administration appoints an FHFA director, that this rule change, regulation change, or guidance, whatever it was, will be retracted.
Wow.
Oh.
There we go. All right. Now we got some headline stuff here, Ed. Thank you. Ed, American Enterprise Institute, are there podcasts or reports or anything that you would like to plug that we should be paying attention to?
Sure. All you have to Google is AEI Housing Center, and you'll be taken to our website. We have something called the AEI Housing Center Heat Toolkit. You just have to put in AEI Heat Toolkit. We have 28 different tools there, all free. We have an immense amount of data. As you know, we're publishing data all the time. We have all these tools out there. There's a lot of map-based information. About probably 10 of the tools are map-based. And so we have a tremendous amount of free data that is just there for the asking.
Fantastic. It's been already a wonderful resource getting prepared for this podcast. I've learned that a lot of things are available that I wasn't aware of. So thank you. Really appreciate your time. You were very gracious with that on short notice. So thank you. We're grateful.
Well, thank you, Mark. Thank you, Jeff. It was a pleasure speaking with you. Have a great day. Take care.
Thank you, Ed.
Boy, what a great conversation with Ed. I learned a lot. I sort of feel my perspective or understanding of this process, but also just the role that Fannie and Freddie play. It's evolving and becoming a little more intelligent, I think. So really, really hopeful that the viewership is reaching that same sort of education. A point I just wanted to emphasize in thinking back on the conversation, and it was not necessarily a prominent point made, but something, Jeff, you and I have been touching on for almost the entirety of the 19 episodes so far. And I remember specifically making it on the Harris versus Trump policy podcast. We had a grid or a chart shown that was showing the housing supply or housing builds for decades, and a huge dip after 2007, 2008, and sort of slowly making its way back up. And certainly we're building more now. But Ed had made the comment that it has been a seller's market since January of 2012. And this really resonates with me. I think it fits the data, and it's largely, before COVID, Jeff, we've talked about the cash buyers. A first-time home buyer is just hopeless to get a house from 2017 to 2020, leading into COVID, because you had all these cash. That's what you needed to win a contract was an all cash offer, and all those sorts of things that are here now. There's no inventory for sale, but any minor, this mission of FHFA of saving borrowers or low-income borrowers dollars in a $200,000, $300,000 loan, whatever, $100,000 loan, whatever it is, in a seller's market like we've lived in for the last dozen years, all that does is allow the buyer to increase their offer to the seller. And most of the time, that is the result that you end up with here, is any savings in the closing process or the loan process just ends up in money in the seller's pocket, because it is a seller's market. And I think it's such an important point as we judge any initiatives, from the macro level, and what their effects are versus what the intended effects are.
That's exactly right. And I love that you've made that point, because in the height of the COVID craziness, I mean, a savings in costs, like you said, only went to increase or try to sweeten the offer to have a hope of getting that in the first place. Now, of course, not having unnecessary or junk fees in any transaction is desirable. I mean, nobody wants a service that isn't truly needed. But if you think about the impact, especially at current home price levels and therefore loan amounts, whatever the cost of an appraisal is, if it's rolled into closing costs, which typically it is amortized over a long period of time and makes, a penny of difference in a monthly mortgage payment or something. I mean, and again, that's not to try to justify just the appraisal fee, but when there are important services that secure the loan and that potentially protect the buyer in the transaction, the amount of cost savings relative to the loan amount and what others are being paid in terms of commissions for real estate agents and loan origination and stuff, it's just not that much, I don't think, when it's all said and done. And there are two sides to most coins, Mark, and on the other hand, I understand the desire to want to get people into housing, but if all you're doing is inflating the cost to get into housing, have you really provided a service? If you put them into something either at more than it's worth or at a price that's higher than what they can, actually or realistically afford, and so having the appraisal in the process does provide some value in the sense of making sure people aren't overpaying, and so it's just there are two aspects to that I think that sometimes come into play, but. At the end of the day, if you can save unnecessary costs, you should. I mean, this isn't a plug to try to promote appraisal fees at all costs, regardless of whether it's really needed or not. But on the other hand, I think you bring out a very valuable point that cost savings oftentimes doesn't even carry through to the borrower so much as and make it to the seller's pocket in a seller's market, which we've had for a long time.
A safe and sound mortgage market is certainly worth the cost of an appraisal or just a reasonable approach at the valuation of the collateral. And great stuff, Jeff. I'm saying this after each episode, but this was certainly one of my favorites. Appreciate that. Hope the viewership enjoys it. Look forward to seeing you all in episode 20.
Stay tuned. Appreciate it, Mark. Thank you.